What should you do with a required minimum distribution that you don't need? Meaning that you have an RMD, you have forced income that's up and above your actual spending needs. Anytime we have forced income that's pushing our taxable income up and above our income need, that's fairly tax inefficient. But nonetheless, some of us find ourselves in this situation for various reasons. Now, if we find ourselves in this given position, what can we do with this excess RMD to either put ourselves in a better position moving forward into the future or enrich our retirement? Well, in this video today, we're going to be talking about 4 different things that you can do with an excess RMD to improve your retirement. Now, ultimately, when we think about a forward-looking tax plan, we want to be minimizing RMDs earlier in our retirement. We don't want to simply wait and procrastinate to deal with these RMDs. But for various reasons, RMDs can kind of creep up on us. And the reason for this is one of 2 things. First off, RMDs, the amount that you're forced to take from your tax-deferred accounts, increases the older that you get. And so you're forced to take more and more from your accounts as you age. Now, your RMD withdrawal rate at age 72 will start out relatively small, and any balanced portfolio will likely have growth that overcomes this given RMD rate. And so there's 2 dynamics here that lead to RMD creep. You're having to take more from your accounts over time, but you're also likely having some portfolio growth within your tax-deferred accounts as well. On the screen right now, I have a chart that shows an average RMD of $1 million portfolio growing at 8% with a 13% standard deviation. And we're essentially running a Monte Carlo here of 100 simulations and averaging out the expected RMD. And as we can see right here, the RMD starts a little bit below $40,000 at age 72. But as this person moves through their retirement and their RMD withdrawal rate grows, as well as their portfolio grows in the first couple decades of having to take RMDs, we see that their RMD skyrockets to above $150,000. And so this person might start out in a situation where that RMD at age 72 is well within their income need, but it pushes up above their income need as they move through time. This is something we call RMD creep. We previously recorded a video on this. I'll link to that in the upper right-hand corner if you want to learn a little bit more about these varying dynamics. And so if we suffer from this RMD creep, what can we do about it? Well, there's a couple different things that we can do. Strategy number 1 is using an excess RMD to pay Roth conversion taxes. Now, you can't convert your given RMD. You can't, let's say, have a $35,000 RMD that we essentially, instead of taking ourselves, just convert that to a Roth IRA. You can't convert an RMD. But we can use this forced withdrawal to essentially use that, pay taxes on that, and use that as tax dollars for an additional conversion. Now, a Roth conversion will cause you to raise your taxable income. That is what a conversion does. But if that conversion helps improve your future tax situation and you're converting at reasonable rates, it can make sense for stopping or at least minimizing RMDs moving forward into the future. So what do a few of these situations look like? Well, let's say you're either an individual or maybe you're a joint filer, and you find that an RMD subjects you to something called IRMA. IRMA is a Medicare premium increase that you will be subject to if you show too high of income. IRMA is based on something called modified adjusted gross income, so you don't get to take the standard deduction. It's also a 2-year look back. And so we're looking at 2022 IRMA tables. This would be for someone that showed a certain level of income in 2020. And so let's say you're an individual and your RMD pushes you up above $91,000 of modified adjusted gross income. Let's say it actually pushes you up to $93,000 of modified adjusted gross income. Well, IRMA here is a tax cliff, meaning that if you earn $1 more than this IRMA threshold, you will owe that full Medicare premium increase for the entire year. And so it might make sense in your situation to fill up and use this entire IRMA bracket. So let's say you're at $93,000 of modified adjusted gross income. Well, performing a conversion to bring yourself up to right below $114,000 of modified adjusted gross income. Again, we have that same IRMA penalty either way. But now with that conversion, we've minimized our tax-deferred accounts that much more. And maybe going into next year, the next RMD falls right below this IRMA target. So we've essentially avoided an IRMA going forward into the next year. You can do the same thing for a joint filer. Another thing that you can look at, and it's very important to know what your tax brackets look like moving through time, but depending on where that RMD makes you fall in terms of your marginal tax rates, it might make sense to continue to max out that full bracket. Now on the screen right now, we have a tax graph for a given individual in 2022. That's a combination of something called the Social Security Tax Torpedo as well as the capital gain bump zone, essentially converging for someone's situation. I'll link to a video in the upper right-hand corner to fully explain how this situation occurs. I'm going to refrain from explaining this in this video just for the sake of time. But essentially what happens here is in blue, this is this person's actual tax rate, their actual marginal tax rate. In red, this is what intuitively they think they're taxed at. And essentially why they're seeing a marginal tax increase is because as they're taking more income, taxable income from, let's say, their RMD, it's forcing more of their Social Security benefit into being taxed. It's also pushing some of their long-term capital gains into being taxed at 15% rather than 0%. And thus, it's creating some higher marginal rates that we see here. Well, let's say in this person's situation, they have an RMD that pushes them through this given tax zone. Let's say they have a $60,000 RMD, and so they've already suffered all of these tax consequences from these given tax hurdles. Well, now they're in a situation where if they continue to show additional taxable income, they're simply going to be taxed at this marginal rate of 22%. Now, if they max out this 22% bracket, their Social Security benefit is already fully taxable. They've already moved their long-term capital gains into being in that 15% zone. And so they're just owing this 22% marginal tax rate. So in this person's situation, it makes sense to convert through the 22% bracket, thus paying 22% tax on a given conversion in order for, in the future, minimizing RMDs. If they are able to minimize RMDs through this given conversion, in future years, they might fall and completely avoid this zone right here, or find themselves with an excess RMD being pushed into a zone that looks something like this. And so essentially in a given year, they are using the tax room that they already have in order to, again, avoid and minimize RMDs moving forward into the future. And so Roth conversions, while still on RMDs, can make sense in certain situations. And so if you already have an excess RMD that you're forced to take, we can use that money to pay taxes on an additional conversion. The next strategy is something called a Qualified Charitable Distribution. This can be used for retirees that care deeply about a specific cause or have a charity in mind that they want to contribute to throughout their retirement. And so let's take someone's situation and look at it as if they were going to just simply take that excess RMD. So in 2022, they have an RMD of $35,000, let's say. Now before this RMD, they are in the 12% bracket. And so this RMD is going to push them through the 12% bracket up into the 22% bracket. And so they're going to owe approximately $6,275 in just the tax on that given RMD. But that RMD is also going to force more of their Social Security benefit into being taxed as well. And so we're going to leave out state tax here, but know that can be an additional tax that we would have to factor into this situation. But just between the tax on the RMD and the tax on the additional Social Security benefits, they're going to owe $11,608.75 in taxes on this RMD, which translates to about a 33.2% effective tax rate on this given RMD, which means if they retain this RMD themselves, they're only going to end up retaining $23,391.25. And so for somebody that's charity-minded, they can either retain this RMD and retain cents on the dollar of this given RMD, or they can pass on this RMD to a charity and have the full amount, that full $35,000, pass on and go to the cause that they care deeply about through something called a QCD. And so here's how a QCD works and how it can be powerful in your situation. A QCD is essentially you're taking your RMD and simply passing it right to the charity. It will escape the tax system altogether, and that charity will receive that full $35,000 benefit. Now, it's very important to understand that a QCD is especially powerful in terms of charity planning because it's above the line deduction, meaning that you don't need to itemize. And so you can take your full standard deduction and still pass on in excess that full RMD, again, because it's an above the line deduction. Now, you must be older than 70 and a half years old. The maximum amount that you can QCD per person is $100,000, and it must go directly to a qualified charity, a 501c3. Strategy number 3 is one of the most common things that retirees do with their RMD. Let's say that you don't have the ability to convert at better tax rates on top of your RMD. Let's say you're not as charity minded, or maybe you've already made your charitable gifts in other ways, but you still want to take this RMD and grow it for the future, maybe for estate planning purposes, to pass it on to the next generation. Well, you can take your after-tax RMD and you can simply put it in your taxable account. Now, this can be fairly powerful in terms of estate planning due to how powerful a taxable account can be in this domain. And the reason for it is something called step up in basis. So let's say that over time you're taking your after-tax RMD and you're investing it in a taxable account. And so because you've already paid taxes on this given RMD, this is going to be counted as cost basis within your taxable account. Now, as this taxable account grows, you're going to have something called an unrealized gain, meaning that you might have contributed $170,000 to your taxable account through these after-tax RMDs, and your current taxable account is worth $240,000. So you have $70,000 of unrealized gain. Now, if you take withdrawals out of your taxable account for income for your situation, you are going to have to pay capital gains tax on a portion of that given withdrawal due to these unrealized gains. But if you pass on this taxable account to the next generation, or if you're using certain strategies and passing on this taxable account to your surviving spouse, they can receive a step up in basis. Essentially what happens here is rather than them still having a $170,000 cost basis, and when they take income from that account having capital gains on that unrealized growth, they receive a full step up in basis to the market value of the account at death. And so now if they take income from this given account, they won't owe any given taxes if there's no additional growth because they receive that step up in basis. Their cost basis is now $240,000. Now, an important thing to think about as you're taking an excess RMD and putting it in your taxable account is you need to be very cognizant and strategic about how you invest that taxable account. A taxable account, if you're not careful, can be a very leaky bucket because anytime you make a change within this taxable account, it can lead to a taxable event and thus lead to something called a tax drag. This is something we've talked a lot about within a few different videos on our Safeguard Wealth Management YouTube channel. I'll link to those videos in the description below. But essentially with this account, you want to be a very long-term investor. You want to invest in low-cost, tax-efficient index ETFs that essentially have a low dividend to avoid dividend tax drag, that have a low turnover to avoid something called turnover tax drag, and thus keep the majority of this money compounding for your future. Anytime you have a taxable event that you're reinvesting any after-tax growth into that taxable account, you will have a given tax drag. And so you have to be careful with these type of accounts. And it's also important to note that simply putting that excess RMD into your taxable account can create a little bit of a circular overflowing problem within your retirement. Now let me kind of talk about how. Well, you have a large excess RMD, let's say. Well, if you're using strategy number 3, you're taking that excess RMD and investing it in your taxable account. Well, that taxable account can generate long-term capital gains due to dividend drag, due to turnover drag. Now, maybe without that large excess RMD, your tax base is low enough that your long-term capital gains can be harvested within that 0% long-term capital gains rate zone. But the problem is you have that large excess RMD that's pushing your tax base up and is pushing those long-term capital gains from your taxable account from the 0% long-term capital gains bracket up into the 15 or maybe the 18.8% long-term capital gain rate zone. And so this is something called a capital gain bump zone. And so the next year the same exact thing happens. You have another large excess RMD. That excess RMD is invested in your taxable account, thus your long-term capital gains liability has grown that much larger due to tax drags from dividends and turnover, and you keep finding yourself in this circular problem again and again in retirement. And so a large taxable account can be fairly powerful in retirement and can be quite tax efficient, but only if you're able to control the other tax liabilities that you have going on. A forced withdrawal from an RMD again, can throw you into this overflowing problem. Now, strategy number 4 will not improve your future financial situation, but I think in certain ways, if you're using it properly, can certainly improve your life situation. And strategy number 4 is spending that excess RMD. I find with a lot of retirees that are in a situation where they have an excess RMD problem, they were very good savers throughout their life. They were constantly sacrificing today in order for an improved tomorrow. And going from that saving mentality to that spending mentality can be very difficult. But in every person's situation, we can often find ways that they can spend a little bit more and have that spending add a marginal increase to their lifestyle. And so what might something like this look like? Well, taking that excess RMD after you're paying taxes on that given RMD and maybe going on, let's say, a family vacation, taking your grandkids as well as your kids out on a vacation. And so you're already in a situation, if you have a large excess RMD, where you're likely not going to utilize all of your dollars within your retirement. So you're already passing on money to the next generation. Well, money isn't the only thing that you can ultimately pass on. And so taking that money, taking your family on a vacation, oftentimes can lead to some of the best memories that not only you have, but also your family has. And those memories will stick with them throughout their life. And so this is just one instance where you can spend this money to enrich your life, but there are numerous other ways depending on your situation, your goals, and what your family situation looks like. And so an excess RMD is obviously something that we want to deal with earlier in retirement. This is the whole point of a forward-looking tax plan. From the time that you retire, or maybe even in the last couple of years that you're working, we want to have a forward-looking tax plan that estimates what RMDs will be in the future, estimates if those RMDs will be up and above our income need, and use strategies like Roth conversions in order to avoid those RMDs down the road. But if we find ourselves in a situation where we do have an excess RMD due to something like RMD Creep, there are still a number of different ways that we can utilize that RMD to improve either our financial situation or our life situation moving forward into the future. Always remember, you don't need more money, you need a better plan. If you like this video, please hit the like button down below, hit the subscribe button. We release videos on a weekly basis. Thank you for taking the time out of your day to improve your retirement. We look forward to seeing you in the next video.